Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people are my friends. Hey, I'm just trying to make a little money. My job is not just to entertain, but educate, to teach you, show how it works. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. When you get an unemployment report that's basically uneventful, it allows you to focus on what's really happening in the market. And what's happening is, once again, a broad-based rally that encompasses many different and often overlooked areas that didn't get much love last year. And that's how the Dow rallied 238 points. S&P gained 0.65%, and the Nasdaq jumped 0.82%. We've seen breathtaking rallies in the data storage stocks. We also have some stocks that simply can't lift, and I got to mention them: Apple and Nvidia. I know you want to know if it's over for these two members of the Magnificent Seven. I come at it a totally different way. I think both Apple and Nvidia, the companies, are humming along, making a lot of money. It's simply that money managers need to sell something old if they want to buy something new. So their stocks become what is known as a source of funds. Do you know it's a time-honored tradition at the beginning of the year? I've seen it happen in January repeatedly over the years. You just have to wait these two out. You'll know when the selling's done. It's truly not over yet, or the stocks wouldn't start rolling over every day from the get-go. And you see it as well as I do. I say own Apple and own Nvidia. Don't trade them. Nothing's changed for me, as members of the CNBC Investing Club know all too well. Are they?
The House of Pain.
Nah, wrong address. Okay, let's go to work here. Now, what are we doing next week? Well, first of all, we are headed at the beginning. Sunday morning, I'm going to a week at the beginning of the J.P. Morgan Healthcare Conference, okay? Now, look, this is a really special event, and it's way too important to miss. I'm going to interview a dozen CEOs to see what their plans are for the new year. Historically, this is a conference where people announce grand plans, including mergers and acquisitions. I've seen a bunch of stories break there over the years. I'm going to cover all the breaking news, especially the acquisitions. There could be a lot of them at this confab, maybe some big biotechs, too. One thing I can say about the J.P. Morgan Healthcare Conference: it's a market mover. You don't want to miss it. Some of these companies are going to announce things that are going to blow you away. Tuesday morning starts with the December Consumer Price Index, and it matters. Today, we had an inconsequential set of Labor Department figures that didn't really impact the stock market. I don't think the CPI will be weak. We're getting some indication that the holiday shopping season was very strong, the strongest in years. Look for some tension between the president, who's trying to contain inflation, and the consumer, who's borne the brunt of it, with the Federal Reserve in the middle, trying to figure out if it's safe to keep cutting interest rates in a rising inflation environment. Tuesday also marks the start of earnings season, with none other than the quarterly report of, yes, J.P. Morgan. Now, I am worried about this conference call, not the quarter, the call. The stock's coming in red hot, and I don't think the company will be as ebullient as the stock would indicate. You got to remember, CEO Jamie Dimon has a certain style. When things are good, he likes to talk about what could go wrong, not what could go right. Things are good. That orientation is what often terrifies people, though. I want to emphasize I think J.P. Morgan's actual quarter will be amazing, but that's not the point. Jamie's cautious comments crushed his own stock last quarter. He could do it again. Remember, I told you, buy it into that weakness. I hope I can be as clairvoyant this time. My suggestion is wait to see if Jamie's worried, cautious, even pessimistic. Watch the stock go down. If that happens, you can pounce on some of it at the end of the day, and you buy some, and then you may have to buy some the next day. That's what happened in the last pattern. Delta reports, too, and I got to tell you, the airlines are putting up some terrific numbers. I expect a fine quarter from Delta, as it's arguably the best-run airline. Wednesday morning, we get not one but two key numbers, okay? We get the retail sales and the producer price index. Now, these numbers, like the CPI on Tuesday, could give the Fed cover to bless us with rate cuts. Of course, there's a caveat here. Unlike the CPI, these numbers are on a delay. They're from November, thanks to that backlog from the government shutdown. I think December was a strong month in the country with big holiday spending. That will not be included. Wednesday also brings more bank earnings. The star most likely will be the one that's been the star for a while now, Citigroup. It's gone from ugly duckling to beautiful swan, but the analysts haven't caught up with the new numbers yet, so it just keeps surprising the upside. We get the upside estimate revisions, and then the stock flies. You know, but it's not the only one. We also hear from Wells Fargo, which we own for the Travelers Trust. Now, this bank stock has been fabulous to us. And Charlie Scharf, the CEO of Wells, has pivoted the bank from a plain old banking company to a full corporate and individual bank, which includes a lucrative merger and acquisition package. They're on the Netflix deal. Wells is constantly paring costs and surprising us with its efficiency. I am optimistic. Maybe he talks a little about how AI is helping them. He's a visionary, Charlie. Bank of America reports, too, and it's been consistently good with very few surprises. I expect none this time, just a solid growth quarter that will help drive up the stock over time. Thursday, we'll get some fireworks. Two investment banks, Goldman Sachs and Morgan Stanley, should both report excellent numbers. The amount of activity in financial markets is unusually strong. The asset gathering in Morgan Stanley has been extraordinary. Ted Pick, good job there. Goldman's takeover business should be tremendous, David Solomon. I expect number increases for both Goldman and Morgan Stanley. We also get to hear results from BlackRock. Remember, they have the most money under management of any company on earth. These guys have been emphasizing all sorts of new kinds of funds. So when the largest repository of money reports, I think it's going to be able to a pretty good number. Unfortunately, in a period when some banks are reporting extraordinary quarters, that might not be good enough for this Travelers Trust holding. Stocks within the same sector compete with each other for dollars. And right now, the banks are running circles around the rest of the financials. Taiwan Semi reports, yes, and that's the manufacturing partner of both AMD and NVIDIA. It should be a monster quarter, but I think everyone knows that. I want to point out that NVIDIA stock has been incredibly weak, despite a steady drumbeat of good news. Maybe a strong quarter from partner Taiwan Semi can help shake off some of the sellers. The winners in the semi area so far, though, have been the opposite of the very complicated NVIDIA. Their data storage simple names like Western Digital, SanDisk, and Seagate, also a little more complicated, Micron. These are the companies right now that are moving up, along with the semiconductor capital equipment companies, two that I'm focused on, Applied Materials and Lam Research. After the close, we hear from truck giant J.B. Hunt, probably seen their trucks on the road. I think this group has finally broken out of its doldrums, the freight recession. I don't typically recommend truckers, very hard business, but a good number from J.B. Hunt emboldens me to keep pushing Federal Express, FedEx. What a winner that's been. Raj Subramanian's just done a fantastic job there. On Friday, we get a big bank break when we can focus on just PNC, a regional bank that's been an up and down performer after years where it did nothing but go up. I prefer the other bank stocks. Now, the beginning of earnings season sets the tone for a bushel of quarters ahead. It makes sense. The banks always kick things off, and it's reasonable to extrapolate all sorts of trends for consumers, right, and corporations, for the financials. The bottom line, a strong start to earnings season could lead to a nice tone going forward. Yes, you can take your cue from the bank earnings. And you know what? I bet they'll be darn good ones. I want to start with Gregory in California. Gregory!
Happy New Year, Jim. And happy 21st on Mad Money.
Thank you, Gregory.
Congratulations.
Thank you very much. You're always very kind to me and to our team. I really appreciate it.
Not at all. I think you've lasted now longer than half the companies that we've talked about on the show. It's incredible.
Thank you.
Speaking of which, I need your help on something today.
Sure, I'm there for you.
Last Halloween, this company blew away the numbers in their quarter on every line, including Q4 guidance, and then they hit an all-time high of $260 and then started to sell off. So I started a small position and added as it continued to drop. And now I'm down 20%. So, Jim, other than profit-taking and scheduled insider selling, as long as they continue to execute, my thesis hasn't changed on Cloudflare. Has yours?
I just yesterday was speaking to a very large investor, and he said, what kind of companies are you looking at that you like? I said, I'm trying to buy companies that are down a lot, maybe, more than just a couple percent from their highs, that are run very well, that do good things, and I'm not worried about the quarters. You know what? That's Matthew Prince. That's Cloudflare, symbol NET. And Gregory, I think you buy a little more here, and if it comes down because the chart is ugly, you buy some more after that. And thank you for the kind words as always. Let's go to Clay in Indiana. Clay.
Hey, Jim. Booyah.
Booyah, Clay.
The stock is Cheesecake Factory. It's been up about 8% this past week. Is it still a buy?
Yes, they really know how to run it. They are just a seasoned practitioner. They know how to do it. I think it's going to make a run at all-time highs. It sells at 13 times earnings. That's way too cheap for a very high-quality, still growth company, even though it's up 14% this year. I like it. Now, I've got to tell you, a strong start to the season of earnings week could set the tone for not just the rest of the year, but, well, I shouldn't say it, could set the tone for a long time. Now, you can take your cue from the banks. I bet they have good things to say. On Mad Money tonight, I'm digging into two consumer names that I know you like very much and are worth highlighting on a Sleepy Friday. First is Shark Ninja, one of the biggest comeback stories of 2025. So if you continue to run higher, I'm taking a look at the appliance maker and giving you my take. Then, Ulta Beauty has been sitting at the top of the new high list almost every day lately. What's working in this beauty name? I'm going to give you my analysis. And by the way, ahead of our trip out to the JP Morgan Healthcare Conference this week, I'm getting a preview of the names and themes to watch with the top healthcare analysts at JPM. I want you to stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
This has been a crazy week in America. So let's talk about something fun for once. Shark Ninja. I know that name makes it sound like a very low-budget horror film, but Shark Ninja makes trendy household appliances. It was one of the greatest comeback stories in the second half of last year. The Shark brand is for cleaning products like vacuums, home environment products like air purifiers, and some beauty and skincare stuff. The Ninja brand is mostly for the kitchen. Everything from small appliances to food prep aids, like their popular ice cream maker, the Ninja Cream. Guys, come on. This thing came public 2.5 years ago after being spun out of a Hong Kong-based private equity firm. At the time, Shark Ninja caught a lot of flack for its Chinese ties, as that private equity firm retained a slight controlling interest in the business. That's no longer true. After a secondary offering in August, that firm now has a 39% stake in Shark Ninja. But its leader, a Chinese national, is still the chairman of the board. In retrospect, all of that focus on China obscured the fact that Shark Ninja just is a fantastic growth story. This company started printing great quarters right out of the gate, and its stock has rallied from a low of $25 in its first week of trading to $120 and change as of today. Now, this one first came on my radar when I interviewed CEO Mark Baracus in April of 2024. Oh, man, he's a sharp guy with a great set of products to sell and a powerful marketing machine. Shark Ninja is, by the way, huge on TikTok. And look, the numbers have been incredible. Shark Ninja reported 9 times since it came public in late September of 2023. And in each of those quarters, the company beat both sales and earnings estimates. That's one reason the stock caught fire in 2024, rallying 90%. However, last year it did run into some turbulence because that simply, let Shark Ninja's shares got ahead of themselves. This thing was trading at about 13 times forward earnings when it came public in 2023. By early 2025, it was trading at 23 times forward earnings. Remember, I tell you the PE is so crucial in how to make money in any market. That's how you value a company, both versus itself and the rest of the industry. When your stock is a higher price to earnings multiple, you've got less room for error. On top of that, Shark Ninja got hit pretty hard by President Trump's tariffs because these guys are traditionally dependent on third-party manufacturers in China to make the products. Right before Liberation Day, management said they wanted to shift most of their U.S.-bound production outside of China, something they started gradually doing under Trump's first time. Still, they moved to Cambodia and Vietnam and Indonesia, and those countries then got hit hard by the tariffs too. And that's why the stock sold off hard early last year, although it eventually rebounded as many of those tariffs got rolled back. They're paying a minimum tariff of 20% on stuff from China and Vietnam, only marginally higher than the 19% tariff on stuff from Indonesia, Thailand, Malaysia, and Cambodia. But if you sold Shark Ninja on the tariff worries last spring, well, you know what? You're probably kicking yourself now. Stock's basically doubled from its lows over its past 9 months. Mostly that rallies happened the old-fashioned way. Shark Ninja just kept reporting better results, and better results, and better results. These guys delivered 3 beat and raised quarters in a row, May, August, and November. Now, the latest quarter reported November 6th was the thing of beauty. Shark Ninja sales increased 14.3% year over year, coming in higher than expected. Their gross margin was up 90 basis points from the year before, coming in almost 200 basis points above what Wall Street was looking for. Put it together, and Shark Ninja delivered an 18-cent earnings beat off a $1.32 earnings growth year over year. On top of that, management raised their full-year forecast across the board. That's what moves the stock higher. So what is going right at Shark Ninja that others may not have going for them? Turns out a lot. Shark Ninja saw growth in all 4 of its product categories, double-digit growth for cleaning appliances up 12.4%, food prep appliances up 11.9%, and especially beauty and home environment products, which were up 56.7% in the third quarter. The latter is an area where the company's been making a big push. Management called out the strength in their carpet extractors, air purifiers, face masks, Ninja Luxe Cafe espresso machines, and one that I bought, the slushy frozen drink machine. Whew. Whenever Wall Street chooses to fret on some external factor like tariffs, this is what they're losing sight of. Shark Ninja's got an incredible lineup of popular consumer products that keep selling very, very well quarter after quarter. I see the lineup at Costco, and I can't resist this stuff. Boy, it looks just like the other stuff that you can pay much more for, and I think it's just as good. Costco wouldn't be featuring Shark Ninja's wares if they weren't, let's say, holding up. It's not easy to get on a Costco shelf. I owned a popcorn company at one time and sold product to Costco. They were incredibly discerning. It had to be perfect. Of course, the tariffs they got an impact here. Management mentioned the margin pressure from tariffs repeatedly on the call. The third quarter had strong margins in part because of tariff timing, something they predicted would reverse in the fourth quarter. So tariffs are a problem for Shark Ninja. I don't want to imply otherwise. But clearly they've been able to overcome that problem. Some of that comes down to what we call self-help initiatives or product cost optimization. I see that term a lot. That's efforts as management described to be able to lower the impact. Some of it's because they no longer need to pay a sourcing service fee to their former private equity parent company. That contract ended last July. And some of it's simply that they, even though the tariffs hurt, they clearly haven't blunted the demand for Shark Ninja's products. I think because they're so inexpensive, and yet they're as good as the expensive ones. At the end of the day, I like this story very much. I want to just put it out there on a Friday where people are all trying to figure out what's going to happen with Venezuela. I'm trying to figure out what's going to happen with Slushmaster here. Look, it all can get better. There's some relief on the tariff front. Wow. Hey, by the way, the Supreme Court, they might strike down the tariffs any day now. Trump administration should be rolling back more of the tariffs that they put in place. Real possibility. Hey, listen, if we get more high-level trade deals, this is the one. Really, though, if the Supreme strike down these tariffs for being unconstitutional, Shark Ninja could have a lot more upside, as it could recoup a lot of money. But let's assume the tariffs remain in place, because I wouldn't want to bet on a very conservative Supreme Court overruling the Trump administration. Even without any relief, Shark Ninja is a company with sales and earnings growth in the mid-teens, and a stock that's trading at just 20 times this year's earnings estimates. As far as I'm concerned, this thing is a steal. Here's the bottom line. Shark Ninja is a terrific consumer appliances company with a proven track record of beating the estimates. So when you see the stock selling for 20 times this year's earnings estimates, I would bet that they'll beat those numbers and the stock ends up looking even cheaper in retrospect. That's why I'd be a buyer. And right here, by the way. And hey, if the tariffs do get axed, well, that's just pure gravy for Shark Ninja. Mad Money's back after the break.
Coming up, Ulta Beauty has been soaring since Cramer recommended it in October. Now he's revisiting it to let you know where it could be headed. Next.
I always keep an eye on the new high list to understand what's working. And for the past couple of weeks, one of my favorite companies has practically achieved permanent residency status, making a new high almost every day. And I'm talking about Ulta Beauty, the largest beauty retailer in the country. It also offers salon services at its 1,400 stores. Now, back in October, I told you that Ulta had finally gotten its act together or grew back after spending a few years lost in the wilderness. Yes, new CEO Keisha Steelman took over a year ago. And boy, she's managed to orchestrate a pretty impressive turnaround. And that's why I recommended buying the stock into weakness just a few months ago. But it's time to revisit it because it's an even better story. At the time, the stock was trading at $523 and Ulta remained mostly in the low 500s for the next few weeks, even touching the high 400s a couple times in late October and November when sentiment towards consumer stocks was at its worst. But over the past month or so, Ulta's come roaring back, climbing all the way to a new all-time high of $675 and change today, though it later pulled back to the 660s. That includes a terrific rally to start this year, as the stock has gained ground each of the last 6 sessions before the new year began, climbing a quick 10%. At this point, Ulta's up 27% since I got behind it in October, and I'm telling you, people, it's not done. So what's gotten into this one? I know I recommended it a few months ago, but even I didn't expect the stock to rally this far. Here's what happened. First, something changed in late November when Wall Street stopped worrying about the consumer discretionary stocks. Between the end of the government shutdown, the realization that the Fed would keep cutting interest rates in December, a strong earnings season for retail, and a very strong post-Thanksgiving shopping season, all sorts of retail stocks caught fire. You kind of threw darts at them. In other words, we got much more benign. Okay, we had a good backdrop for the whole industry, but then when Ulta reported December 4th, they shot the lights out. Just listen to some of these numbers. Net sales were up 12.9% year over year, substantially higher than expected. Same-store sales were up 6.3%. You know, the street was only expecting just 3.5%, with positive comps across all of Ulta's categories and channels, including double-digit growth in e-commerce. Ulta's gross margin was up 70 basis points year over year to 40.4%, and that was well above the 39.3% number that the analysts were expecting. And they earned $5.14 per share. You know, the street was only looking for $4.61. Management also raised their full-year forecast across the board, taking their same-store sales guidance from 2.5 to 3.5% range up to the 4.4 to 4.7% range. That's gigantic. They also raised their earnings guidance by well over $1 per share at the midpoint. On top of that, Ulta's forecast for their fiscal fourth quarter, which ends this month, was much better than expected. All right, so how'd they do it? On the conference call last month, CEO Keisha Steelman explained that ever since she took over, she's been trying to strengthen the core U.S. business, scale up new business, including the international biz, and streamline Ulta's cost structure. Apparently, those efforts are paying off. Let's take them one at a time. To turn around the core U.S. business, Steelman said she had to improve the in-store shopping experience, making sure more items people want are in stock and the stores are better staffed. Basic stuff, but clearly it's working. She also said that Ulta had big success with its seasonal promotions. Those have always been pretty good. In terms of product categories, Steelman explained that all major categories exceeded management's expectations. Specifically, she called out real strength in fragrances and skincare, while makeup, hair care, and services were all solid. Finally, Steelman went into detail about how Ulta's been able to grow its online business, more personalization, more stores that can ship things directly to your home. So the core U.S. business is definitely stronger, but what about scaling up new business? Right now, Ulta's focused on expanding overseas. During the quarter, they opened up several new stores in Mexico. Mexico is booming, by the way, while also opening the first Ulta in the Middle East in Kuwait. And they're integrating Space NK. That's a British beauty retailer that they acquired just last July. At the same time, Ulta recently launched its online marketplace. I mentioned this back in October. It's where they sell both their own merchandise and stuff from third parties. Apparently, that's going very well. Finally, there was plenty of talk about the third strategic priority, too, cutting costs. Now, I'm not going to bore you with too many of these details. Management talked about retrofitting distribution centers with more automation, new warehouse software. But the key point is that cost savings are coming through, hence the stronger margins and the rising earnings per share. Wall Street loves that. Put it all together, and you've got a retailer that is indeed firing on all cylinders. In fact, I'd go so far as to say that it's looking a lot like the Ulta of old. The innovative growth story that was run by Mary Dillon for so many years before she went to work at Foot Locker. Wall Street loved the old Ulta for good reason, and now it's falling back in love with the new Ulta. Of course, at this point, we're no longer early. Ulta's rallied a quick 27% in just 2.5 months since I recommended it. The stock's not yet super expensive, selling for just over 23 times the year's earnings estimates. But it's certainly more expensive than it was before, now trading at a bit of a premium to the overall market versus a slight discount when I recommended it in October. But you know what? if you didn't listen to me last time, I still think you can buy Ulta here and get some exposure to this excellent story, which is not quite a true turnaround story yet, but is definitely a getting much better under new management story now. If you took my word for it in October and you bought the stock, then it's a hold. Oh, and congratulations on your quick gains, though. Either way, with Ulta stock white hot here, I mean white hot, you should be hoping for a market-wide pullback that gives you a chance to load up on this one at a really good level. The bottom line is that Ulta Beauty continues to look better and then better some more. The stock's certainly run a bit at this point, but I think it's got more upside as the company is starting this new year with more momentum than at any point in ages. Let's go to Buddy in Rhode Island. Buddy.
Hi, Jim. Happy New Year to you. Wishing you the best of success for 2026.
Oh, you're very kind, buddy. Right back at you. I really hope that things go well for you this year.
Thank you very much. Elf Beauty, I bought it about $77. It's now about $87. I hear about a big benefit with the tariff going up. Is this something to hold, or should I take the profit and move on?
Okay, the stock's been troubled. And a lot of that, I think, is because people are confused about the Chinese with the manufacturing. Let's do this. If you get a tariff overturned from the Supreme Court, this stock's going to go up 25 points. Let's just hold on to it for now, because I think it's actually reflecting some of the weakness that I don't even think is there anymore. I think Tarragamine is terrific. Let's go to Sam in my old home state of Pennsylvania. Sam.
Jim, how are you?
I'm good, Sam. How are you?
I'm good. Jim, I got an interesting question from my grandfather, Stuart Ebby. We were at a Hanukkah celebration, and he mentioned he bought Kimberly-Clark as almost a bond proxy, but he was concerned about the recent acquisition of Kimberly-Clark and the stock's underperformance. So I'm curious what you think about Kimberly-Clark, if it's worth holding on to, or if it's worth selling and buying something else.
Okay, so I think a lot of the weakness is more involved with Kenvue. But remember, Procter was shown for the Chopper Trust also went down. But they're buying Kenvue, and people don't like that because it's got all this. It's got some issues. I'm not going to say liabilities. That's too mean. I mean, it's too negative. But I will say that I think Michael Hsu is doing a fantastic job with what the hand he's got. It's got a 5% yield. I think it seems very intriguing to me here at 13 times earnings. And thank you for the question. I think Ulta's been looking better and better these days. Even though it's run up a bit, I still think there's some more gains ahead. Much more mad money ahead. I always like to get a taste of the biggest themes to watch ahead of next week's JP Morgan Healthcare Conference before I head out there myself in San Francisco. And that's why I'm going to sit down with JP Morgan's Lisa Gill, who's so fabulous to hear about it all. Then a lot of attention is being paid to the oil stocks right now, and rightfully so. But I think another type of energy is being forgotten in all the excitement, and not necessarily in a good way. I'm going to tell you what I am seeing. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Next week, I'm headed to San Francisco for JP Morgan's 44th Annual Healthcare Conference. It's a pilgrimage that's become an annual tradition for us here at Mad Money, and for good reason. This is the industry's most important conference, and we can't afford to miss it. So to get a sense of what it might look like, we're checking in with Lisa Gill, Managing Director at JP Morgan and the head of their Healthcare Services Equity Research Team, who's been a fantastic aid to us, and she's also a terrific host. Ms. Gill, welcome back to Mad Money.
Thanks, Jim. It's great to see you, as always, ahead of the conference.
Well, I've got to tell you, Lisa, I can't wait. Every year there seems to be different buzzes. I was once next to some people who put a deal together. I was next to private companies. I was next to someone where they pre-announced a quarter. Another person defended their right to be able to sell things. What is the buzz this year?
Yeah, I mean, I would say it's probably away from my space and probably more towards pharma, biotech. I mean, biotech has been on fire, as you well know. And I think there's a lot of expectations around perhaps parties coming together. As you know, a lot of times those are the first times the meetings happen at the conference, not necessarily where the announcements come. But I think that's where the excitement is. I think for us, drug distributors, you and I have talked about them for a number of years now, did incredibly well last year. Again, all returning, somewhere around 50% plus. So from our perspective, we're looking forward to hearing what they have to say around their managed services, organization businesses, some of the acquisitions that they've made. So we're excited from that perspective.
Well, let me ask you, I was with the folks from J&J the other day, and they announced a very big deal. And they're talking about Trump RX and talking about lowering drug prices. And yet these middlemen, which the president seems to have a little bit of antagonistic feel toward, still did so well. How's it possible?
So I think drug distributors are incredibly important and save dollars to the overall healthcare system, right? So they're very good logistics coordinators getting products from point A to point B. And to be honest with you, MFN or other pricing doesn't have a direct impact on a drug distributor. I'll give you an example. If you remember a couple of years ago under IRA, insulin pricing went to $35. You would think that that would have had an impact on their margins, and it didn't, because the manufacturers realized that they're really important around the logistics of getting that product, in a very safe manner to the patient.
Okay, so then let's talk about what the president's impact may be. He seemed to be, I think, setting his sights on the health insurance companies soon. That's what my sources say. Are people going to be the scuttlebutt of who he's going to go after next?
Yeah. And so we're really excited. We have Dr. Oz on a panel on Tuesday morning, and we're hopeful that he's going to talk a little bit about how they're thinking about Medicare Advantage going forward. Now, there was a lot of chatter in the fall that perhaps they were going to go after the managed care organizations, and we didn't see that. We'll see the preliminary rates for Medicare Advantage in early February, and that could be an opportunity for them to make some changes. As you saw, right, Department of Justice having fraud, waste, and abuse within healthcare. So I think that, he clearly has his sights set on fraud, waste, and abuse. But I think Medicare Advantage is a very popular program that's worked really well for a public-private partnership. And I think many in the Trump administration really believe in that type of a partnership. Okay,
well, let me ask you along those lines. You introduced me to the new team at CVS. And I know Mr. Joyner's not necessarily new anymore, but I think he's doing remarkable things. Do you think they can tell a good story?
So they're not presenting this year at the conference. They just had their analyst day in the middle of December. And so David said, hey, look, we're going to absolutely be there next year. We're not going to make it this year. But I agree with you. I think I shared with you last year, Jim, that I've known David Joyner for more than 20 years. This stock returned nearly 80% last year, but it still trades at less than 12 times next year. So I really think that there's an opportunity here for them to continue to deliver. Their Medicare Advantage rates are well below what they have been historically. Believe it or not, retail pharmacy is doing incredibly well.
I can't believe it.
We think it's going to be like a break-even business, right? It's been down year after year. But look you've had Walgreens close stores. You've had Rite Aid go bankrupt. They bought Bartell's on the West Coast. I think what you're starting to see is more normalization. The shift to a cost-plus model in drug retail, I think, is helping them. So I really think that CVS, which is one of our favorite names going into 26, can continue to deliver. And we would expect, why can't they trade closer to a drug distributor multiple, right? I mean, the drug distributor is trading at high teens. And like I said, you've got CVS still trading at less than 12 times.
It's just so cheap. I want to circle back to biotech for a second. We got used to under Biden the idea that if a big drug company wanted to buy a smaller biotech, they didn't like it. The FTC didn't like it. We've now had this huge deluge of biotechs. Do you expect us to start? Do I need to start learning about a lot of new companies because they are very attractive to the old dogs?
Listen, I don't follow biotech directly, but from what I hear from my team, there's a lot of innovation going on in the marketplace. And I feel that from my seat that this administration is much more open to transactions than what the Biden administration was open to. And clearly you see this with the large pharma companies and the amount of capital they have, right? And so I really think that there's probably some opportunities, and I think we'll probably hear more about that speculation next week when we're all in San Francisco.
Okay, last question. I always find that people don't understand that AI is still early in drugs. Are we going to hear anybody talking about how AI has sped things up, made things better? Because I have not been impressed so far with what the drug companies have done with AI.
Yeah, I think that's going to be a top question for everyone, right? And my expectation is that every company, not just the pharmaceutical companies, but also the healthcare services companies, you're going to have healthcare information technology companies. I think everybody's going to be talking about, can AI truly create more efficiency? Can they speed up the process around drug development? We will have OpenAI talk about their healthcare initiative on one of the panels out at the conference this year. So I do think it'll be a big topic.
All right, that's very exciting. I can't wait to see see you out there. It is one of the most exciting things I ever go to in my career. That's Lisa Gill. It is Lisa, head of JP Morgan's Healthcare Services team, and someone who does an amazing job at a fantastic conference. Thank you for giving us the lowdown ahead of it, Lisa.
Thank you.
Good to talk to you.
Thanks for having me.
Of course.
Thanks for having me, Jim. Great to see you.
Mike Mike's back after the break. Stocks headed by myself, WS cost over my staff first, the graphics by you play the sound. And then the lightning round is over. Are you ready? Skate that. On the lightning round, Chris, I'm going to start with Lori in Florida. Lori.
Booyah, Jim. Okay,
Booyah, Lori.
Looking to expand my portfolio to include lithium. I'm considering Lithium Americas.
No, Lori. Wrong one. You went Albemarle. Even though it's up a lot, it's a much safer stock. The symbol is ALB. Let's go for that one. I need to go to Scott in Indiana. Scott.
Good evening, Jim. Thanks for taking my call.
My pleasure.
Anyway, happy holidays to you and your team and your families, and especially Josh and Dylan. They do a great job. You're a lucky man to have those guys on board.
Oh, am I ever. I'm looking at one of them to say, hey, man, good job. Okay.
Thank you. My question is about D-backs. I bought D-backs 3 years ago in February for $12.
Congratulations. You know that one's done. They got that nice bid from Santa Fe. I'm going to actually go out there and talk to them about that. That's a hefty shot. Well played, my friend. How about Maria in Florida? Maria.
Hey, Jim. How are you?
I am good, Maria. How are you? Same.
Good. Thank you for empowering everyday investors like me.
Oh, I sure
Jim,
try.
Yeah, I'm underwater, Jim. For the last several months, I've been suffering through a down spell with Talon Energy. I bought and sold this stock several times in 2025 and made a profit. However, on this last cycle, it's been challenging. I bought back
No, I think you're okay. Actually, Maria, I think you're okay. It's come down. I know it's come down a lot, but it's only down 1% for the year. I think you're fine. As a matter of fact, I actually would be inclined to buy some here. I don't want you to sell that stock. Let's go to Carter in Tennessee. Carter.
Jim, tell me what you think about SailPoint, SALIL.
No, that's the kind of enterprise software that I just can't tolerate right now. I just do not want to be in anything like that. The only one that my travel trust is in is Salesforce, and even there, they punish you every day on the darn thing. So let's steer clear step one. Why don't we go to Peter in Florida? Peter.
A warm and sunny booyah, Jim, from Dr. Pete in Bonita Springs. I wish you a happy and healthy New Year.
I like Bonita Springs. Thank you.
Radiant Logistics.
Hey, interesting company. I like the logistics company. I like the truckload company, but I have to tell you, I come back. If you're going to be in that business, you want to be in FedEx. They got the logistics that you need. I'm not kidding. FDX. Kevin in California. Kevin.
Hi, Jim. Calling you from warm and sunny Whittier, California. Longtime listener. I just wish I listened to you and took your advice more often. Otherwise, I wouldn't be calling you right now.
We're fine. We're fine.
I own Amgen and with my own cash, and I've done good with First Solar, but I bought it on Monday at $275 on margin, and I was a big pig.
Whoa, no, we don't want that. You don't live in, you can do a loan for a house. You can live in it. The president says corporations don't live in them. But First Solar is not good enough to be that. It's 16 times earnings, but and I like the company very much. But no, you're gonna have to take. You have to cut your losses. I will not. I can't tolerate being buying on margin. Let's go to Matthew in Texas. Matthew.
Yes, sir. Thanks for taking my call.
Of course.
All right. So I've got this company I've been watching for a while. They make batteries for drones, satellites. They've had a nice pullback. What's your thoughts on Amprius Technology?
An interesting spec. I was thinking about them when Ford decided to no longer do its battery business. I think you have something there. It's a nice spec and it's come down. I am going to say that that's a good one. Let's go to Craig in Tennessee. Craig.
Booyah, Jim from Nashville, Tennessee.
Oh, my God, Nashville. I mean, if one more person tells me to go to Nashville, what can I say? I'm going to Nashville. How can I help you?
You need to do a show from here, Jim, that's for sure. Jim, I've had a stock for about a year now that I've lost 23% on. I need to know what to do with ticker symbol ARM.
Oh, with ARM Holdings, that's Renee Haas. I think he's doing a real good job. I don't know why the stock keeps going down. I think I'm a buyer, not a seller. What can I say? I think Renee's doing a good job. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, with more companies considering nuclear energy to power their ventures, Cramer's tuning his microscope to see when or if it could happen. Next.
These days, there's an awful lot of attention being paid to all sorts of energy stories. Meanwhile, the oil stocks are roiling on the possibility of an oil revival in Venezuela. The president convened a meeting of the top oil executives today to try to persuade them to invest, although they don't seem all that interested. Even he's put up a $100 billion oil revival roadmap. You know, though, the president can be very persuasive. Normally, when our country overthrows the Latin American government, big business is eager for piece of the action. This time, though, the oil companies aren't that thrilled because if Trump's successful, Venezuela will start pumping a lot more oil and the price of crude will plummet. They don't want to sow the seeds of their own destruction. Far more interesting to me was the story that Meta Platforms is buying and building facilities that will generate enough power for the expansion of their AI infrastructure. Meta's buying electricity from 3 Vistra plants, nuclear power plants. But what caught my eye was their commitment to buy power from the small nuclear reactors being built by Oklo. Meta gave 2030 as the date when these nuclear plants will be pumping out electricity. Oh, I wish they hadn't said that. I wish they hadn't given us that time frame. Because almost every company that has tried to build nukes faster than we thought you could have had hideous delays and cost overruns. They have to hope that small firm nuclear reactors will take a lot less time. But this is a new technology, so I wouldn't bet on it. Why not? Well, in 2009, Westinghouse got a contract to build 2 nuclear reactors, but big kind, for $14 billion. This was for Southern Company. They were supposed to start producing power in 2016. In reality, they weren't up and running until 2024, and the final cost was closer to $35 billion. Almost wiped out the company. Don't get me wrong. If you want clean energy, nuclear is the best solution long term. But, man, it takes a very, very, very long time to build these things, even the small forms, which are quite different from the Southern overrun plants, but are still novel and nuclear. Ooh, toxic combo. The tech execs embrace nukes because they hate fossil fuels. The problem is these CEOs don't know the hazards of getting into the nuclear business. They remind me of the confident, even smug executives from Southern Company that used to tell me that don't worry about a thing. The ones who almost sunk their business with that nuclear project, their confidence eventually dissipated. I know that in theory, these new nukes are supposed to be much easier to build. But this is a heavily regulated industry because nobody wants a nuclear meltdown. Plus, there are so many nuclear facilities being built at this moment right now. I wonder how these builders can find the workers needed to put up the plants or the materials. Or to put it another way, I wish Meta had given themselves more time instead of just making that promise for 2030. Right now, the country is gripped with a terrible shortage of construction workers of all kinds. There are lots of material shortages. All over the country, frankly. In many cases, the companies have promised to produce the power on time. They don't even know what they're dealing with. The industry's too crowded, too much demand, not enough supply from any certainty. The companies in the nuclear food chain never want to admit that there could be mistakes in the construction process. They act like these are no different to building a natural gas turbine. I wish that were the case, but given the history, Chernobyl, 3 Mile Island, Fukushima, you have to expect the unexpected, which means delays. That's why the utilities gave up on building these things years ago. And it's why I wish these nuclear neophytes, like Meta, would try not to overpromise. Of course, I'd love to be wrong. If Mark Zuckerberg can somehow find a way to build a nuclear plant on time, give that man a Nobel Prize. Sadly, I wouldn't put money on it. I'd like to say, as always, bull market summary. I promise I'll fight just for you right here on Mad Money. I'm Jim Cramer. See you Monday from the J.P. Morgan Healthcare Conference.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC or its parent company or affiliates and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.